Welcome back to Investing Talk Podcast.
Today we're looking at Rocket Lab.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave in the comments below.
So let's get into the analysis. Rocket Lab is showing a really significant operational and financial step change right now.
A step change?
Yeah. When we look at their Q3 2025 performance, the numbers, well, they don't just look good, they look like acceleration.
Okay, give us the headline figures then. What kind of acceleration are we actually talking about?
We are talking about record revenue. They hit $155.1 million in Q3 alone.
Wow.
And that's a massive 48% jump year over year for the quarter. But, the real story is the consistency here.
So it's not just a one-off spike.
Exactly. If you stretch back to the trailing 12-month revenue, that growth rate climbs even higher to roughly 78% year over year.
Okay, explosive revenue growth is one thing, but that often comes with volatility, especially in aerospace. How much visibility do they have? Is this pipeline secured?
That's the critical difference. This is what elevates their story. They exited Q3 with a huge verified order backlog of $1.096 billion.
$1 billion cushion. That sounds phenomenal, but what percentage of that is actually, short-term secured revenue?
That's the detail that gives management so much confidence. They anticipate approximately 57% of that entire backlog converting into realized revenue.
So well over $500 million.
Yep, and within the next 12 months. That visibility stretching into 2026 really minimizes the execution risk. They know exactly what they need to deliver.
Okay, let's unpack the profitability piece. Historically, high-growth space companies, they just burn cash like crazy to achieve scale. Has that changed?
This is where the narrative really pivots and where the value of their vertical integration starts to, shine. We are seeing major structural improvements in their margins.
Oh,
Their gross margins are climbing, hitting a range of 39 to 41% in Q3.
41% gross margin in the launch industry is a huge statement. What does that specifically tell us about their business mix?
It tells us that the space systems segment, not just launch, is absolutely dominant in high margin.
Right.
Pure launch competitors, they struggle to get anywhere near that.
Yeah.
But Rocket Lab sells proprietary components, satellite buses, propulsion, solar arrays at that 40+% margin.
So the high margin parts are basically funding the big, ambitious rocket programs.
Precisely. It provides the operating leverage, and we're seeing that translate directly to a narrowing net loss. The Q3 EPS loss improved to just 6 cents.
And management is targeting cash profitability, not just GAAP income. You're talking about EBITDA.
Exactly.
For our listeners, why is hitting operating EBITDA break-in such a critical milestone for a company like this?
That's a great question. EBITDA is basically a proxy for cash operating profitability. It ignores the huge non-cash expenses like depreciation from building launch sites.
Got it.
So for a company that needs to constantly invest in R&D, achieving operating EBITDA break-even means the core business is finally generating enough cash to cover its own costs.
A true inflection point. And this isn't coming at the expense of liquidity either. They seem to have a massive war chest right now.
They do. Liquidity surged to $807.9 million, bolstered by a recent equity offering. They have the firepower to execute their vision.
And all this momentum led them to lift their guidance and set that ambitious Q4 goal. What's the new outlook?
Management raised the full year 2025 revenue guidance to a range of $720 to $740 million.
And the break-in goal.
That's the big one. They've set the goal of achieving operating EBITDA break-even by Q4 2025. Hitting that is the single most important catalyst on the horizon.
Okay, moving beyond the financials, let's look at the competitive landscape. You mentioned they're building a moat through vertical integration. What does that mean for a customer?
It means high switching costs. I mean, if you want to put a satellite in orbit, you need the satellite components, you need ground control, and you need the ride itself. Rocket Lab offers all three.
So if a commercial client uses their satellite parts, they're essentially locking themselves into using Electron or Neutron for the launch.
That's it. If you're already running their proprietary hardware for your satellite's power system, the simplicity of booking the launch with them is immensely valuable. It's why space systems command 60% of the entire backlog.
And that strategy is deepening with acquisitions. Tell us more about the Geost purchase. How does that fit in?
The Geost acquisition, which was almost $290 million, strengthens their ability to deliver complex solutions in the highest margin segment of the market, space-based sensors.
And why are space sensors so strategic?
This isn't just selling standard parts. This is highly sophisticated, often classified technology for government and defense customers. It expands their footprint with U.S. defense agencies who sign massive multi-year contracts.
So the space system side is expanding. But we can't forget launch, which is how they built their brand. Electron seems to be having a great year.
It is. Electron is still the small launch market leader. It secured 17 launch contracts in Q3 alone. Its edge is proven reliability. It's the go-to choice.
And that stability generates the cash flow for the bigger vision.
The bigger vision, which is Neutron. This is where the company's valuation truly lives because it takes them into the medium to heavy lift market.
Right, competing with the big players. What's the latest on the Neutron platform?
Neutron is the future of their launch revenue. A much larger reusable rocket targeting payloads up to 13,000 kilograms. It opens up huge new markets for them.
What's the official timeline versus, the market chatter?
The official line for the first flight is still 2026-2027. However, the market is buzzing with speculation that key milestones are coming faster than expected.
Oh.
We've heard persistent, unconfirmed chatter that the first orbital test fire might happen as early as late Q4 2025. If that happens, it would be a massive upside shock to the stock.
Which leads us perfectly into market sentiment. The fundamentals look strong. How is the market reacting, technically speaking?
Technically, the stock is in a confirmed uptrend. Shares are up over 45% in the last 3 months.
A huge move.
A huge move. And critically, it's trading comfortably above both the 50-day and the 200-day moving averages. That's a strong bullish signal.
Is this just retail traders chasing momentum, or are the sophisticated players jumping in here?
It appears to be driven by significant institutional accumulation. Institutional ownership is high, almost 68%. We've seen major firms like BlackRock disclose enhanced positions.
And we'll get confirmation of that trend soon, right?
Absolutely. We're waiting for the upcoming 13F filings. They're due around December and January, and they will reveal exactly how much major funds bought during this strong Q3 period.
What about insider sentiment? What are executives doing with their own money? Are they selling into this strength?
The insider signal is overwhelmingly positive, which is pretty rare after a run-up like this. While you had some minor sell-to-cover actions for taxes.
Which is just noise, really.
Right. The key data point is CEO Peter Beck. He made a significant open market purchase of $2.1 million worth of stock in October.
That is a massive vote of confidence. When the CEO, who knows the Neutron timeline better than anyone, commits over $2 million of his own capital at these prices, it sends a powerful message.
It absolutely does. It suggests the leadership believes the stock is still significantly undervalued.
Okay. Moving forward, what catalysts should we be watching for in the next 3 months?
The most crucial event will be the Q4 2025 earnings release, probably in February 2026. That report will show the Geos integration and, most importantly, confirm if they hit that EBITDA break-even goal.
Any other factors that could move the needle?
Operationally, the market is watching for two things. First, that accelerated Neutron timeline we talked about. And second, there's a recurring strong rumor that they're close to a major new government contract win.
A multi-launch agreement.
Exactly. A win of that scale would immediately boost the backlog even further.
Now let's play devil's advocate. With the stock doing so well and so much priced in, what are the primary risks?
The risks boil down to 3 key areas. The biggest is execution risk tied directly to Neutron. Developing these vehicles is incredibly difficult. Any delay or setback could really hurt sentiment.
And financially, they still need to spend a lot of money.
That's the second one. Financial risk.
Right.
They aren't sustainably profitable yet, and developing Neutron requires ongoing high R&D spending. High fixed costs could pressure margins if the schedule slips.
And finally, they're still in a very volatile market.
Right. Market risk. The aerospace sector is high beta. A major market correction could still drag the stock down, no matter how well they're executing.
I also saw some of that unconfirmed chatter about other strategic moves.
Yes, 2 rumors stand out. One is a potential joint venture with a major European aerospace firm, which would give them access to EU launch sites and defense funding.
Interesting. And the other?
The other points to a partnership with a major cloud provider. That would let them enhance their satellite data services, moving them even further up the value chain.
So, drawing this all together, the revenue acceleration, the integration moat, the narrowing loss, and the strong insider confidence, what's the overall thesis here?
The thesis is that Rocket Lab has successfully transitioned from an R&D startup to a vertically integrated executing growth company. The combination of guaranteed backlog, improving margins, and strong institutional buy-in provides a robust fundamental base for investors looking to play the long-term expansion of the space economy.
That successful execution is indeed the hinge the entire investment thesis turns on. It forces us to ask a final provocative question. Considering the aggressive investment and the market's anticipation for the neutron rocket, how much execution success is already priced into the stock at these levels, and what happens to that valuation if that key timeline slips even slightly? Something for all of you to ponder as you continue your research.
And as always, make sure you hit that subscribe button to catch our next analysis.